Your credit score is a three-digit number that controls more of your life than almost anything else you will ever be judged on. It determines whether you get approved for the apartment. It determines the interest rate on your car loan. It determines whether a mortgage lender takes your call or ignores your application. A difference of 200 points on a credit score can cost an ordinary American tens of thousands of dollars over the course of a lifetime in higher interest rates alone. If your score is sitting around 500 right now, you are not broken. You are not disqualified. But you are paying a penalty every single day in higher rates in declined applications, in security deposits that people with higher scores never have to pay. Here is the step-by-step path from 500 to 750. Not theory. Not general advice. The specific sequence of actions in the right order that moves the number. Step 1. Understand exactly what is dragging your score down. Before you do anything else, pull your free credit reports from annualcreditreport.com. You are legally entitled to one free report from each of the three bureaus, Equifax, Experian, and TransUnion, every week. Pull all three. They are not always identical. You are looking for three things: errors, negative items, and your current utilization. Errors are more common than most people realize. A 2021 study by the Consumer Reports found that more than one-third of Americans had at least one error on their credit report. These errors can range from accounts that don't belong to you, to incorrect payment statuses, to debts that have been paid but still show as open. Disputing and correcting errors is the fastest thing you can do to raise your score because it costs nothing and can produce results within 30 to 45 days. Step 2. Address your credit utilization immediately. Credit utilization is the percentage of your available credit that you are currently using. It makes up 30% of your FICO score, the most widely used credit scoring model. If you have a credit card with a $1,000 limit and you are carrying a $900 balance, your utilization on that card is 90%. That alone can drop your score by 100 points or more. The target is below 30% total utilization. The ideal is below 10%. If your score is at 500, high utilization is almost certainly part of the reason. There are two ways to fix this. Pay down the balances, which is the right long-term answer. Or request a credit limit increase on your existing cards without increasing your spending, which immediately lowers your utilization percentage without requiring you to pay anything down. Both approaches work. Combining them works faster. Step 3. Stop all new hard inquiries for at least 6 months. Every time you apply for a new line of credit, the lender performs a hard inquiry on your credit file. Each inquiry can drop your score by 5 to 10 points. When you are already at 500, you cannot afford to lose points on applications for cards you may not be approved for anyway. 6 months of no new applications gives your score room to breathe and recover from recent damage. Step 4. Become a credit builder. If you have limited credit history or your existing accounts are all in poor standing, you need to add positive payment history to your file. There are two reliable ways to do this. The first is a secured credit card. You deposit a fixed amount, typically $200 to $500, and that deposit becomes your credit limit. You use the card for small recurring purchases like a streaming subscription or a gas fill-up, and you pay the full balance every single month before the due date. The card issuer reports your payment history to the credit bureaus, and over time, consistent on-time payments build your score from the ground up. The second is a credit builder loan offered by many credit unions and community banks. You make fixed monthly payments into a savings account that you receive at the end of the loan term. The payment history gets reported, your score improves, and you end the process with a lump sum saved. It is one of the few financial products specifically designed to benefit people with low scores. Step 5. Pay every single bill on time from this point forward. Payment history is 35% of your FICO score. It is the single largest factor. One missed payment can stay on your credit report for 7 years and cause an immediate drop of 60 to 110 points depending on your score at the time. If you have missed payments in your recent history, the damage does not disappear overnight. But its impact fades over time as you add months and then years of clean payment history on top of it. Set every account to autopay for at least the minimum. Then pay extra when you can, but never miss the minimum. Step 6. Keep old accounts open. The length of your credit history makes up 15% of your FICO score. Closing an old credit card account, even one you no longer use, can shorten your average account age and lower your score. Unless the card has an annual fee that isn't worth paying, keep it open and make one small purchase on it every few months to keep it active. Step 7. Be patient with the timeline and aggressive with the process. Going from 500 to 750 is not a 90-day project. Realistically, with consistent action, you can expect to move 30 to 50 points in the first 60 to 90 days by correcting errors and reducing utilization. Another 50 to 75 points over the following 6 to 12 months as positive payment history accumulates. The final stretch to 750 typically takes 1 to 2 additional years of clean history, low utilization, and account diversity. The timeline feels long. The actions themselves are not complicated. They are just specific, and they have to happen in the right order, and they have to be maintained without interruption. Financial advisor and author John Alzheimer, who spent years working inside FICO and Equifax before becoming a credit expert, describes credit building as a patience game that rewards consistency above everything else. There is no shortcut that permanently moves the number. There is only the sequence done correctly, maintained over time. Your score was not built in a day. It will not be rebuilt in a day. But every month you do these things correctly, the number moves. And at 750, the financial system treats you like a different person entirely. Because in every way that it can measure, you are.